Meet David, 52 years old, $480,000 in his portfolio. March 2024, he does something that sounds absolutely insane. He sells his entire gold position, $87,000 worth, right before what everyone said would be the biggest safe haven rally in history. Gold dropped 12% in 3 weeks. Bitcoin dropped 15% in the same period. They moved together. Down. At the same time, his friends thought he was an idiot. But here's what nobody understood. Think of portfolio diversification like having 2 lifeboats on a ship. Your financial advisor tells you, one's made of wood, one's made of rubber, different materials, they'll never both fail at the same time. Then the ship hits an iceberg, and you discover something nobody mentioned. Both lifeboats have the same type of valve, and that valve just froze solid. Doesn't matter if one's wood and one's rubber. They both sink. That's what just happened with gold and Bitcoin. For years, the pitch was simple. Gold is the old world safe haven. Bitcoin is the new world digital gold. They're different, uncorrelated, except they just both zagged. Hard. It's not that both assets went down, it's that they went down together for the same reason, at the same time. That valve, it's called liquidity. Let me show you what this looks like with real numbers. You've got $100,000 invested, 10% in gold, 10% in Bitcoin, 80% in stocks. March 11th, 2024. Your gold position is worth $10,000. Your Bitcoin position is worth $10,000. April 2nd, 2024. Your gold position is now $8,800. Your Bitcoin position is now $8,500. You lost $2,700 from your safe haven assets in 3 weeks. Historical correlation between gold and Bitcoin from 2020 to 2023, it averaged 0.13. They basically moved independently. March 2024 correlation, 0.87. That means they're moving together 87% of the time. They're not hedging each other. They're amplifying the same risk. Here's the thing nobody tells you. Wall Street sold you on the gold Bitcoin diversification story because it's profitable. When you own both, they collect fees on both. They had zero incentive to tell you these assets could correlate during the exact moment you need them not to. Correlation isn't static, it's conditional. Gold and Bitcoin can be uncorrelated in normal markets. But in a liquidity crisis, they're the same trade. March 2020, COVID hits, markets panic. Gold and Bitcoin both crashed. Both dropped 25–30% in 2 weeks. Everyone said it was a one-time event. It just happened again in March 2024. Different crisis, same result. Why? Because when institutions need cash now, they don't sell based on fundamentals. They sell based on liquidity. The stuff you thought was safe becomes the stuff they dump first. There's academic research from the Bank for International Settlements that analyzed 40 years of safe haven asset performance during liquidity shocks. The finding? When liquidity contracts by more than 15% in a 30-day period, safe havens experience synchronized selling 73% of the time. In March 2024, market liquidity contracted by 18% in 22 days, and right on schedule, gold and Bitcoin sold off together. The psychological trap is thinking you're protected because you own different assets. You look at your portfolio, you see stocks, gold, Bitcoin, maybe some real estate. You think, I'm diversified, I'm safe. But what you're actually holding is 3 different expressions of the same bet. Liquidity conditions stay normal. Most people confuse asset class with risk exposure. Gold is a different asset class than Bitcoin, but they're the same risk exposure when liquidity dries up. Let me give you a concrete case study. Meet Jennifer, 41 years old, marketing director, $420,000 portfolio, 60% in index funds, 20% in gold ETFs, 20% in Bitcoin. Textbook diversification, March happens. She lost $38,750 in 17 days. Here's what she should have done. 60% in index funds, 20% in short-term Treasury bills, 20% in investment-grade corporate bonds under 2-year duration. She would have lost $15,160 instead of $38,750. That's a $22,990 difference. Same starting capital, same time period. Different understanding of what safe haven actually means. Here's the danger nobody talks about. I call it the digital gold delusion. Bitcoin is called digital gold. Gold is a proven safe haven for 5,000 years. Therefore, Bitcoin must also be a safe haven. That's not logic, that's marketing. Gold has 5,000 years of human behavior proving it holds value in crises. Bitcoin has 15 years, and in 3 of the 4 major liquidity crises during that time, it crashed. If your safe haven drops 15%, the exact moment your stocks drop 8%, it's not a safe haven. It's just another risk asset wearing a disguise. Here's what you actually need to do. 1. If you're holding gold and Bitcoin as diversification, run the correlation numbers for the last 6 months. If correlation is above 0.6, you're not diversified. Sell one or both and move into actual uncorrelated assets. 2. If you're going to hold Bitcoin, hold it for asymmetric upside, not as a hedge. If you've got more than 5% of your portfolio in Bitcoin and you're calling it diversification, you're mislabeling risk. 3. Stop thinking about asset class. Start thinking about risk exposure. You want real diversification? Hold assets that actually perform differently under stress. When liquidity dries up, short-term sovereign debt goes up. FDIC-insured cash stays stable. Everything else goes down. The people who actually built wealth through multiple market cycles weren't the ones chasing the narrative of the moment. They were the ones who understood the one thing that actually matters in a crisis: liquidity. When markets panic, liquidity is the only moat. Cash is king. Treasuries are queen. Everything else is a court jester pretending to be royalty. David put his money in 6-month Treasury bills, made 5.3% while gold dropped 12%. His friends stopped laughing. If this clarity hit different, like and subscribe. Drop a comment with your current gold and Bitcoin allocation as a percentage of your total portfolio. And if you're sitting on a diversified portfolio that just cost you 10% in 3 weeks, maybe it's time to rethink what diversification actually means.